Okay, let's unpack this. If you were watching the precious metals markets back in December of 2025, you saw something, well, something historic, and then, in an instant, a terrifying reversal. We're diving into the silver market's incredible volatility. We saw it peak near $65 an ounce, a nominal high, only to just execute this sharp, sudden retreat that wiped out billions in paper value in minutes.
It was more than just a wild swing. You have to see this as a market structure event. Silver had been on this relentless climb, right? Powered by huge fundamental demand. But the retreat, that wasn't triggered by physical weakness. It wasn't some new silver mine discovery. Our sources all point to the same thing. This was caused by complex trading mechanics, specifically the exchange itself stepping in to manage risk.
And that is the absolute core of our deep dive today. We want to understand the sheer power of this paper market and how it can just override what's happening in the physical market.
Wow.
We're investigating the margin trigger retreat. I mean, the event involved over 67 million ounces in paper contracts traded in a flash.
Yeah, that volume, done in just a few minutes, that tells you everything you need to know. This wasn't a headline about mining. This was the plumbing of the financial markets seizing up for a moment. And you have to remember the context here. Year to date, silver had already climbed more than 100%. It started January 1st, 2025, around, what, $31? So the market was already tight, it was volatile, and frankly, it was ripe for some kind of institutional intervention.
Okay, so let's set the stage. Let's talk about the ascent and that peak. We really need to nail down the drama of that surge. Silver advanced pretty steadily from the high 50s, right through the first 2 weeks of December. Then it peaked at an intraday high of $64.66 on December 12th. That was a number that just grabbed headlines everywhere.
It did. And you watch that ticker hit 64.66 and you think, wow. But then you watch the closing bell and the story changes dramatically. Spot prices closed that day at $62.01.
62.01. So that closing price was already a daily decline of 2.41%.
Exactly. The correction was instantaneous, it was violent, and it was highly concentrated in time.
I remember seeing that chart live, and it looked like a glitch, like a classic fat finger error, not some kind of fundamental shift. But even with that huge drop, the metal was still up 18.56% for the month. That really just underscores the power of the momentum that was driving it up to that point.
It absolutely does. But we do need to pause on that $65 figure, just for anyone following the history of precious metals. Yeah. Hitting a high nominal price, the highest number you see on the screen, that's one thing. But when you adjust for CPI inflation, it's important to note that we were still significantly below the peaks we saw back in 2011.
Right. So to put that into perspective for you, the inflation-adjusted high from 2011, that was somewhere in the range of $70 to $72 an ounce. So while 65 was huge, we hadn't actually breached the true historical ceiling in terms of purchasing power.
Correct. The surge was massive, but the market technically still had room to run based on historicals. And what drove that initial surge throughout 2025, taking it from 31 to 65? It wasn't just short-term hype.
It felt like the macro tailwinds were just ferocious all year.
They were. The whole surge was built on this foundation of shifting monetary policy. We had a strong expectation of Federal Reserve rate cuts, which makes non-yielding assets like metals more attractive than, say, bonds. You combine that with persistent physical supply constraints, which we'll get into, and this macro environment of continuous U.S. budget deficits. I mean, that historically erodes the purchasing power of the dollar. Silver was behaving exactly as a hard asset should.
Okay, so strong macro, strong demand, tight physical supply. That gets us over $60. So why the instantaneous plunge? If the demand story is so solid, how does a market drop over $4 in an afternoon? And that brings us to the moment the futures exchange basically hit the emergency brakes.
Yeah, that pullback wasn't organic. It wasn't a shift in sentiment. It was administrative. The immediate trigger was the CME Group, which runs the COMEX futures market, putting in place an immediate, very dramatic adjustment to silver futures margins.
So the CME raises the collateral demands for the main futures contracts, December 2025 and January 2026. This is where we need to slow down a bit because the word margin can be really tricky. It doesn't mean what it means when you, buy a stock.
That's the crucial distinction. It's so important. When you buy a stock on margin, you're borrowing money to buy the asset. You own the stock. Futures margin is completely different. It's really a good faith deposit. Some people call it a performance bond. It's just collateral you post to guarantee that you can cover your daily losses if the price moves against you.
So you could be controlling a 5,000-ounce silver contract worth, what, over $300,000? But your actual margin deposit, the cash you put up, might only be $15,000 or $20,000. It's a tiny fraction.
Precisely. And that's what makes futures trading so highly leveraged. And because that risk is so leveraged, the exchange reserves the right to raise those requirements instantly. And that's
Mm.
exactly what the CME did. They decided the volatility was too high and the risk was becoming systemic.
Wait, hold on. Why is a rapid price rise dangerous to the exchange? Isn't the risk mostly on the people who are short selling, who bet the price would fall?
That's a great question, and it gets to the heart of risk management. When silver's price explodes up 100% in a year, yeah, the short positions are hemorrhaging money. If the price keeps climbing that fast, some of those short sellers might just default on their contracts. They run out of money. The clearinghouse, the entity that guarantees every single trade, is then on the hook for all those massive losses.
Ah, so the CME raised margins to protect itself, to protect the whole system from a cascade of short sellers defaulting because they just couldn't cover the losses from that $65 spike. They forced them to either post a lot more cash or just get out of the trade.
That is exactly right. They compel these highly leveraged traders to immediately post a huge amount of additional collateral, the margin call. And if you can't, you have to liquidate your position. It's a self-preservation move by the market's infrastructure.
And the market's response to being compelled like that?
It was an immediate deleveraging cascade. One source called it a liquidity vacuum. Traders who couldn't meet those new capital demands, they had no choice. They had to sell their leveraged positions instantly. This led to a stunning, concentrated sell-off of 13,430 contracts.
And one contract is 5,000 ounces, so.
So that equates to a volume of 67.15 million ounces, all of it dumped into the market in the span of just 15 minutes. And when that kind of paper volume hits a thin market, it just overwhelms all the buy orders, and you get that rapid price crash we all saw.
67 million ounces in 15 minutes. I mean, to put that in perspective for you, that is almost 10% of the entire projected annual global mining production for the year. The volume is shocking, but what does it really mean for the physical silver market? Does this imply there's suddenly a glut of physical silver?
No. And this is the core insight for you to take away from this whole deep dive. These events just underscore the fundamental disconnect between derivative trading and the tangible physical supply chains.
Yeah.
The traders who sold those contracts didn't suddenly find 67 million ounces of silver bars in a warehouse to deliver. They were just closing out leveraged bets on a screen.
But how does selling a futures contract instantly drag down the spot price for actual silver? That's where arbitrage comes in, right?
Arbitrage is the bridge.
Yeah.
In simple terms, big institutions that trade futures are also watching the spot market. If they sell futures contracts heavily, the price of the future starts to fall below the spot price. An arbitrager sees that little difference, and they can profit by simultaneously selling the expensive spot silver and buying the cheap futures contract. They lock in a small, risk-free profit.
And it's the cumulative effect of all those arbitrageurs selling physical spot silver to lock in that profit. That's what forces the spot price down to match the collapsing futures price.
Exactly. It transmits the selling pressure from the paper market directly into the quoted spot price. It generates these huge short-term swings without a single ounce of extra physical metal being involved. Market observers all agree this sell-off was purely deleveraging. It confirms that the underlying physical tightness, that's still completely intact.
But I wonder if that volatility itself hurts confidence. I mean, if I'm a solar panel company trying to budget for the next year, do I suddenly think silver is less reliable because the futures market blew up?
That's a perceptive point. While the volatility introduces uncertainty, you find that physical market participants, they tend to focus on different metrics. They're not usually trading on minute-by-minute COMEX swings. They're watching dealer premiums, how much they have to pay above the spot price to get their hands on the metal, and they're watching inventory levels. Those things operate independently of these short-term futures moves. They care about the supply chain, not hedge fund leverage.
That makes sense. The CME solved a problem on Wall Street, but it didn't solve the long-term problem facing industrial users. So let's pivot away from the paper market for a second and focus on those fundamental drivers. The whole reason the price got over $50 in the first place.
This is the real story of silver. It has this crucial dual role. Gold is primarily monetary, but silver is both monetary and profoundly industrial. And its industrial demand isn't just strong, it's essential. It's non-substitutable in a lot of high-tech applications.
We always hear about its use in solar power. How significant is that really?
It's massive. Silver has the highest electrical conductivity of any element, period. That makes it pretty much irreplaceable in things like solar, photovoltaic, or PV panels. We're talking about global commitments to renewable energy, and every standard solar panel needs about 20 grams of silver. When you project the ramp-up in panel production globally through 2030, that demand curve is almost vertical.
And that's not even counting the EV transition, advanced electronics, all these things that need high conductivity components.
Absolutely. The industrial demand is just structurally increasing year after year. Now, connect that robust demand back to the supply side. Analysts are projecting that the 2025 market deficit, meaning demand, is higher than supply will exceed 200 million ounces.
A structural shortfall of over 200 million ounces. That's what really puts the squeeze on the market. How can a deficit that big even be sustained without the price just rocketing forever?
Well, it comes down to mining mechanics. Unlike gold, which is often a primary metal you're digging for, about two-thirds of silver supply is a byproduct. It comes out of the ground when you're mining for base metals like copper, lead, and zinc. This means that silver production inherently struggles to match these rapid surges in silver-specific demand. You can't just decide to ramp up a silver mine. You have to ramp up a copper mine first.
So if the deficit is baked in by geology and consumption is skyrocketing, that explains why we've seen exchange inventories declining so much. The structural pressure is immense.
And then you just layer the macro factors right back on top. Those persistent U.S. budget deficits, the inflation expectations, they continue to erode the dollar's purchasing power. That maintains the appeal of precious metals as a hedge. And silver also has this unique dynamic where it often strengthens during periods of economic uncertainty, providing that crucial safe haven function.
So let's try to synthesize this, because this is really the core lesson for you, the learner, trying to navigate this market. If you came to this deep dive curious about this $65 spike and the crash, you've now seen two powerful, very distinct forces at play.
On one side, you have the physical reality, a structural industrial deficit projected to exceed 200 million ounces, driven by irreversible technological demand in solar and EVs. That's the engine that drove the price up over 100% in a year.
And on the other side, you've got the derivative reality, the immediate, powerful, short-term impact of institutional risk management rules, the exchange jacking up margins, which caused that flash retreat. It's a literal tug of war between the paper contract market and the underlying physical asset.
Understanding both is crucial for anyone involved with commodities. And for those of you who want to track the fundamentals beyond the daily noise, the sources we reviewed mention resources like the World Silver Survey. They provide excellent, non-speculative data on the real supply constraints.
So the playbook for the modern investor seems to be understand the deep supply issues, but always, always keep an eye on what the exchange is doing with margin requirements, because those short-term rules can be violently decisive.
That's the perfect summation. Margin adjustments illustrate, with just stark clarity, how institutional rules shape prices just as much as broad economic forces. So here's a final provocative thought for you to chew on. Given that the structural deficit is projected to be immense, over 200 million ounces, and the physical supply chain is so strained, how long can this highly leveraged paper market keep a lid on the physical price? Before tangible scarcity, the simple inability to get your hands on the metal dictates the next massive and potentially far less reversible move.